What's going on, everybody? Welcome to the Delta Corner. My name is Adam, and this is my options selling journey. In this video, I'm going to be breaking down my strategy for selling options and what I look for, and I might do a little breakdown of some of the trades I've done so far. I started this back in January 2026. It is now July. Kind of wanted to do a mid-year check-in. Also, I had the idea to document this, so hopefully other people can learn. This is not financial advice. I'm not a financial advisor. This is purely educational. I just wanted to document my journey. So hopefully some people can learn from this. And yeah, we'll get into it. All right, everyone. Like I said, we're going to get into my strategy for the wheel and kind of my options trading journey. I'm going to start off with this little presentation I have, kind of what I look for in trading options and selling options. Like I said, I primarily utilize the wheel strategy. I'll kind of get into a little description of that and what it looks like. And yeah, let's get into it. All right. So for those of you who don't know, the wheel cycle is a strategy for selling options. It is very much an income based. So it's about creating income. It's not so much about stock appreciation. It's very much more about the whole generating income from your money, similar to, collecting dividends, except this is a bit more work and it's a bit more fun, in my opinion. So it starts off with selling a put. So if you don't know what that is, maybe do a bit more research. I can do another video on actually breaking down what options selling is, but this is just an overview. So basically, you collect a premium for selling a contract to somebody, saying that you're going to buy buy a certain amount of shares if it dips below a certain price before expiration. So for taking on the risk of having to buy shares from somebody at a certain price, you get to collect a premium upfront. I think the best way to explain this is that, say there's a stock that's trading at $100, and you say, okay, in 30 days, if it dips below $50, I will buy 100 shares. So this is the $50 is your strike price. And so if it goes to 40, you're forced to buy 100 shares times 50. So you'll be on the hook for $5,000. It is a capital intensive strategy. You need to have cash up front. These are called selling cash secured puts because you have the money available to buy the 100 shares at a certain price. Let's forget that zero. I don't know what that zero is there, but it would be $100 times 50, so you'd be on the hook for 5,000. That's kind of the main idea. As you sell puts, you collect the premium for taking on the risk of it dropping below the 50. And if it goes below the 50 by the date it expires, then you have to purchase it. It'll be an automatic thing unless you are able to manage it, but that is for another video. Once you sell it, say it goes below the 50, you are assigned. So this is the first step. This is the second step. So if you're assigned, you buy the shares at the strike, like I said, $50. And now you have to sell a covered call against those 100 shares. So selling a covered call, you need to have 100 shares. And same thing for that, you collect a premium for taking on the risk of your shares being called away. So this is kind of the inverse. If it goes above your strike that you set, say it's $100, it goes to 120, you are forced to sell the shares at $100 and you don't get the upsides if it went to say 120 or 150. You don't get that additional, you just get the $100 times your 100 shares. Um, that's kind of a simple way of looking at it. So again, you collect a premium for that. And then if it goes above, that means you get called away. You sell the shares at the strike, and then you restart and you sell the puts and you restart. And that's kind of why it's the wheel cycle. It just keeps going around and around. And your main focus is on these collecting premiums. That's kind of the whole strategy behind this, and it's something I started doing. Um, all right, so now that we got that out of the way, I'm gonna do a little dive into my wheel checklist, and I have 6 indicators that I look at before selling any puts. So I guess we can kind of get into that. So these are the main 6 that I look at. No particular order. They're kind of all important. They all play a role. There's some that I really go into and focus more than others. There's a little leeway in some, and I'll explain that in a bit. But basically, delta, you want that to be under 30, and I'll kind of get that into that in a second. Day to expiry, 28 to 42 days. You want no earnings in and around the expiration date. Your return on capital, you want it to be over 1%. Relative strength index, this is a chart indicator. You want that under 30. Under 30 is a little conservative. I would do under 40 is okay too. Um, I would do under 40, under 30. And then IV rank, your implied volatility has to be over 50. Um, and the key part here is this bonus kind of indicator is it has to be a stock that you want to own. You don't want to be assigned on a stock that you had no intention on ever owning, because then you're more likely to sell at a loss and just get rid of it instead of completing the wheel cycle. So I think this one is probably the most important one. You want it to really be a stock that you do not mind owning for a while as you go through the strategy. All right. So first off, delta under 30. This is basically the odds of assignment. So how likely you are to be forced to buy those shares at your strike price. Um, at a 30 delta or lower, you means that you roughly have a 70% chance that the put expires worthless. If it expires worthless, that means you collect 100% of the premium. Now, it's pretty rare that you wait till it expires worthless at 100%. Typically, you want to close that out earlier so you can free up cash to do another trade and sell another option. So, really, you want to wait till it's at 50 to 70% of the realized, of the captured premium. Um, that's kind of a little tangent there, but basically the delta is the chance of it's expiring worthless. IV rank, so implied volatility. If it's a little more complicated of a concept, but it's not too. It's I'll give kind of a rough understanding and my rough understanding of how it works. Basically, this is a 52-week range of the volatility of the stock, so you want it to be over 50. What that means is that the stock is kind of volatile, right? Like it goes up or it goes down. So there's kind of a range. And if it's doing a lot of these movements, it means the implied volatility is high relative to what it's been before. And that's when the premium is rich enough to justify the risk. So because we don't know if it's going to go up or down, we kind of have to take on the risk of selling that. And that's why the premiums are good enough to justify that risk. So when this is over 50, that means what you're risking is worth the premium. All right, days to expiration. This is kind of the key thing here. when it comes to selling these options, you want it to be between 28 and 42 days. Now, there's a whole bunch of different strategies. Like I'm saying, this is my strategy, and it's not something I've come up with. What I'm doing is relatively common and relatively safe. Not safe, but you know what I mean. It's a very common strategy that I'm doing. This is nothing new. There's plenty of other videos. There's probably better videos than this one explaining the whole strategy, but I'm just kind of documenting what I've been doing. Um, some people do weeklies, some people do monthlies, some people do 2 monthlies, but between the 28 and 42 days, that's kind of when you have the theta decay sweet spot. This is the decay of the time value of money. So as you approach the expiration, it really ramps up, and that's when you start collecting the real premium. And it also it stops you from tying up your buying power for months on end. So about a month, and I'll kind of get into my average holding period for these in a bit. But yeah, about a month is pretty good for these types of returns that you're getting. Return on capital. I want this over 1%. So the capital that I'm risking needs the return on that needs to be uh, over 1%. If not, then honestly, I don't really think it's worth it. I think you could probably find a better trade to do. You don't want to be chasing trades, and if it's not getting you at least 1% of the capital, personally, I don't think that's worth it. All right, RSI under 40. Like I said, under 40 is a bit better than 30. It gives you a bit more room to execute trades. So that is the relative strength index, and this is kind of the momentum. It's the momentum indicator of a stock. So if the stock's been going up for a while, that means the relative strength index is probably pretty high, like somewhere over 70. And you want to avoid selling options or selling puts when the RSI is high, because if it's been going up for a while, well, you could probably assume that it's going to go down and there's going to be a pullback at some point. So you want to avoid selling it at this. That's why you want to look for the RSI to be about 40, so around this range when it's on a downswing, because that means it's probably likely it's oversold. And then it's probably at some point, people are probably going to realize that it'll probably kick back up at some point, and then that's when you can realize your profits and buy back at a cheaper price to realize the premium. Um, Now, this is not always true. It could stay oversold for a while. The market's very irrational, so that's kind of where the risk is at. But it is one of the indicators to look at, I would say. No earnings before expiry. That's kind of just a good indicator that a lot of people look at. Uh, it's pretty easy. You just check their earnings calendar, see where it's at. Um, there's a little leeway to this. I try to avoid setting it the week of the earnings. I either set my expiration 1 to 2 weeks before or extend it out 3 weeks past earning. This is because, stocks become very, very volatile around earnings, just because, you know, even just looking at Google this past 2 weeks, they had amazing earnings and the stock still went down like 5%. It makes no sense. So you kind of want to avoid having your DTE, your day to expiry, the week of the earnings. And I can get a bit more into that in a different video. But yeah, so that's basically my checklist. It's kind of one of the main indicators I look at. It's nothing too complicated, but it really helps keep me dialed in and checked, and rest assured that at least I'm following a strategy and not to deviate too much from that. All right, next we'll get into a little breakdown of my dashboard and what I've done so far. So we'll see that right here. All right. Hopefully this isn't too hard to read here. give a little breakdown of kind of what I've done so far. So this is my starting capital. I hope it's not too hard to see here, but I started with about $36,500 USD. I'm in Canada, so I had deposited $50,000 Canadian into my account. And at the time I made the Forex trade, like I exchanged my Canadian into USD because I wanted to do all my trades in USD. It ended up coming out to about $36,000, $500 and change. Um, so far in the 6 months, I've realized $2,300 in realized net profit and loss. So it's only realized once you buy back and close out the trade. So when you collect the premium upfront, that is not technically realized because your capital, your cash is tied up in potentially having to buy the shares. So this is only realized for trades that I've closed. So far, I've got about 6.3% return. Not too bad. It's not great. I'm hoping to kind of do a bit better going forward. Total fees paid. I use IBKR. There's a whole bunch of different platforms you can use. I find the fees to be okay on this. I kind of like their interface. I'll probably go into that in a different video. Um, this I won't touch on. I started doing leaps, but that's for a different video. My win rate is about 90%, so I've been assigned once out of all the trades I've done. Um, and I think I've done about 12, 10 or 12 trades. Yeah, I think 10. Um, and right now I have three open trades. So this is my cash secured put performance here. I have about $28,000 out of my 36 tied up in cash secured puts right now, which is running at about 82%. That's pretty high. I'm not a big fan of that. I want to keep that closer to around 50 just so I have cash on hand in case things really do hit the fan. Um, and I'd still have cash left over. My average day to expiry when I open a trade is about 34. So, like I said, that's right in that sweet spot between the 28 and the 42. Average return on capital for each trade is about 2.3%. So that's nicely above the 1% threshold that I have for myself. My average day to close is 20. So like I said, average day to expiry is 34, but usually you want to realize the profits at around 50 to 70% of the captured profits. And that for me has been happening around 20 days, around the 20-day mark. So that's when I go to buy back the contract because I sold it. So you have to buy it back to close it. Average delta is 16. This is honestly pretty conservative. I could be closer to probably 20 or 25 even. I've just, since it's my first year doing this, I've kind of been a bit more conservative, but like I said, well under the 30, the 0.30 delta that I said earlier. Average profit is about $200 per contract. I haven't mapped it out, but what I've been able to do so far is about, if you average all this out, it comes to about $300 per month, which is honestly not too bad. Using $3,600, that's about a 10%. Now it varies, but I'll kind of explain this right here. So because I don't have that much capital, I'm pretty limited in what I can do and the amount of trades I can have open at the same time. When you look at this, here, I'll zoom in a bit more here. When I look at this, you can kind of see how it ebbs and flows. This means that I sold contracts here, and then I realized the profit in this month. So I bought back this month. I sold the contracts in April, and then I bought them back in May. I sold the contracts in June and bought them back in July. So you can kind of see that without that much capital, it's harder to have a consistent cycle. Not that you can't do it, but it definitely varies a lot more in how many contracts you can sell and when you can close them out. Um, Here's my profit per ticker. These are kind of all the tickers I've done so far. And like I said, these are all stocks that I'm okay owning for the next little while, like even years on end at this point. I will say this, there's different strategies when it comes to picking stocks. These are very high beta stocks, lots of volatility, um, lots of risk involved in these, lots of volume. So they can swing pretty hard. But again, like I said, I don't mind owning any of these stocks for the next little while. Some people like to do more conservative, like consistent blue chips, or even dividend paying stocks. Lots of different strategies, but this is mine. Um, Now, if you go to the per ticker, missing my iron. Oh well. Um, Per ticker, kind of how many trades I've done per ticker. My big one has so far has been NBIS. Um, it's kind of the one I found the most useful and the best premiums so far. It's also a stock that I really like so far, so it's been pretty good for that. Here's just my cumulative total. That's a hard word to say. So you can see in July 2026 so far, we made the $2,300. Um, like I said, here I've been assigned once, so I have one open covered call. I sold it for $117, and it's for Iran. Um, this is the amount of cash that I had to use to be assigned. So, like I said, it's the strike price times 100. So it was $45 times 100, which gives you 4,500, but minus the premium I received for selling it. Um, and yeah, that's kind of the breakdown of what I've done so far. I think I'll go into this in a different video, kind of break down all the trades I've done. I can give a quick example here. For the month of July, I have three open here. So if you look at, zoom in here, you can see for NBIS, I have one expiring at the end of next week. Friday, you can see here the expiration date is July 31st. I opened it at the beginning of the month. And this was a 17 Delta. Sold it for $10.08. So times 100 shares, I got $1,000 for it. So that was the biggest one I've done so far. You can see a lot of these other ones are about $200, $300. There's some bigger ones like $600 here. That kind of depends on what type of stocks you're looking at and which ones you're doing. Here's the fees I have to pay. So after the fees, how much cash I actually received. And then the cash required to be potentially assigned. So you can see the 180, the 180 strike times 100 is 18,000. So I need to have 18,000 minus the premium that I received. So if it were to expire and I'd have to buy the shares, I collect the full premium, but I have to buy the shares for this amount of money right here. So you can see these are open. All the other ones, like I mentioned, I try to buy to close. I don't let it expire. There's no point really. You're better off buying to close early and then redeploying the cash. Um, and then here's my realized profit for each and one of them. Uh, this one I was assigned, so there's no realized P&L so far. That's kind of what my next tab is for assignments. Here are the numbers of days to close. So you can see like some of them, like this is insane, like 3 days it took me to close this one because the stock shot up and it was already at 70% of the total premium. So I just closed it. 9 days here. This one was a loss because I had to roll it into the next month. It was the first one I ever did. I'll get into rolling and strategies on managing in a different video. But basically, I bought back at a loss and then resold at a profit the next month. So I still ended up making quite a bit of money on it. But yeah, this first one, I kind of took a hit on it. Like I said, I'm still learning the strategies, still learning the process, and that's kind of what I wanted to share here. But yeah, this is kind of what I've been able to do so far. And if you want to follow along, that'd be great. We can learn together. All right, like I said, that's about it. This is my options trading journey. I hope you follow along and subscribe, and we can do this together. I'm open to suggestions for content. I have a few ideas and kind of maybe do like monthly breakdowns of what I've done so far in the month, what I closed, what I have open. And I'll probably post another few videos here and there, maybe more on strategy and kind of what I look for. But yeah, that's something you're interested. Please subscribe, follow along, and yeah, leave a comment on what type of content you want to see because this is very free format. I'm not a good editor. I'm not going to be editing much. These are going to be very raw videos. So I hope that's okay. And yeah, welcome to the Delta Corner. I'll see you next time.